Beat the Market, the only show in Zimbabwe that deep dives into everything equities, markets and finance. I'm Ibn Mabunda. Let's get started. Now, coming up, the International Monetary Fund recently completed its staff monitored program Article 4 in Zimbabwe, where it is that it tabled a few recommendations that would be crucial to Zimbabwe's macroeconomic stability. First, the IMF did commend Zimbabwe for its efforts that it has made on the monetary front, as well as key strategic initiatives that are crucial to the country's fiscal regime. Now, on Beat the Market today, we explore the itemized elements of this Article 4 mission with a regular contributor to Beat the Market, as well as an economic analyst in Zimbabwe, none other than Malone Gwadu. Now, Beat the Market, be right back. Don't go anywhere. Welcome back to Beat the Market, the only show in Zimbabwe that deep dives into everything equities, markets and finance. I'm Ibn Mabunda. We get on with our conversation. Now, I'm joined by economist Malone Gwadu to look into the Article 4 mission of the International Monetary Fund that, of course, took place here in Zimbabwe. Malone, hello and welcome to Beat the Market. Fantastic. Now, to get the ball rolling, what exactly is a staff monitored program and why is it important for Zimbabwe?
Well, it's a very interesting time for this to happen. In a primitive term, I would say staff monitored program is basically where the IMF comes in, looks at your economic policy management framework, its soundness and its ability to meet the preset objectives, and gives its a tacit rating. But it's an informal agreement, nothing committing, but it's just more of an advisory and technical competence role that it plays in your overall economic management policy framework, comprising of mainly the fiscus, that's the fiscal policy, monetary policy, as well as the acts that surround that, such as the Public Management Finance Act and transparency, audit, reporting, and all those things.
Right. How does a successful staff monitored program enhance Zimbabwe's credibility with international lenders and investors?
Well, I think it acts as a layer of assurance for intended stakeholders. For example, international lenders, when they hear they're being in staff monitored programs, it speaks to adherence to good governance, it speaks to good management of finances, and it speaks to overall intended will to reform and implement policies that best suit international practice.
Right. Why did the IMF stress that a track record under an SMP is needed before full re-engagement?
I think it gives a signal of the intended will to reform and to provide good governance and the necessary frameworks that are there for re-engagement. You'll be aware that Zimbabwe is pursuing various initiatives on the international fora for debt, for its debt restructuring and bridge finance and all those things. So the staff monitored program speaks to the economic policy management framework that will be given a thumbs up by the International Monetary Fund.
Right. How can Zimbabwe adhere to the discipline that's been presented by, of course, the IMF? And what is your assessment of the political will to meet the expectations of the International Monetary Fund?
I think the will from authorities is there, but maybe the mismatch may come around the timing. The intended spending for it to be a cash budget is there, it has already been disclosed. And the gradual refining of the willing buyer, willing seller system, which reflects the market value, has already been implemented to some extent through the ADLA, bidding model that has been orchestrated by the central bank. So, in the medium to long term, it's a possibility, but it's in the midst of competing demands. We've got local vulnerabilities such as commodity prices, vulnerabilities, and we're coming from a drought where there was serious need for cautionary spending by government to caution citizens from hunger. So by and large, I'd submit that it's possible, the will is there, but sometimes circumstances may push there to be a temporary setback for those to be met.
Right. Before we delve deeper into the recommendations, the IMF did commend the authorities in Zimbabwe for a good number of reforms, starting with the removal of the cap on the willing buyer, willing seller, which, of course, the IMF says is a move in the right direction and perhaps a beacon of hope toward full market liberalization. Why is that important?
Well, basically, it's about the value of the overall economic activity. A cap speaks to a bit of an artificial rate, so there's need for there to be gradual price discovery that reflects the market value of the rate. But at the same time, we'll be aware that the ZIG was introduced at the back of a runaway inflation and exchange rate volatility. So while this we want to deal with IMF, intended efficiency, we also need to be cautious of what the unintended consequence of inflation and volatility, which is the benchmark of what the ZIG is trying to address in the market. But in the medium to long term, with the right fundamentals gradually being achieved and being improved, it is a possibility for there to be a market-determined rate, as been the case where the Reserve Bank has called in bids from a free market through, of course, the necessary channels and not necessarily the whole market-wide reflection. So in the medium to long term, it's a possible achievable target.
Right. At the same time, there was, of course, a commendation where the generation of income by the government was concerned, with the IMF commending the increase in terms of the revenue generation by ZIMRA as well as through other government initiatives. How is that important to Zimbabwe's economic agenda vis-a-vis the plea that would be presented or raised by members of the public as government perhaps being too punitive in its revenue generation initiatives?
Well, I think it comes with the redirection that government has taken. You'll be aware that there was transfer of quasi-fiscal operations from central bank to government that came about as a result of usage of central bank funds. But now we are redirecting government spending towards taxing, which is the ideal policy framework and fiscal management that's supposed to be there. But it comes at a cost of, heavy taxing for the industry, which can crowd out private sector competence and commercial value. So there's probably need for there to be a struggle of balance between the government needs of increasing revenue, but at the same time supporting private sector initiatives and being patient from a strategic perspective and providing the necessary environment that thrives, that makes business thrive and be able to tax more later, but not immediately.
Right. Parallel market premiums, as noted by the IMF, have declined from highs of 60-70% last year, and now they are around the territory of 20, sometimes even less. When you speak to that shift in that movement there,
I think it reflects the intended policy framework, which is arrestive and prohibitive for excessive liquidity in the market and no money supply growth. So by derivation, there's limited money supply of the ZIG, and there's adherence to the policy framework that is set of there being spending based on production. No money supply that will be circulating outside production. So you'll be aware that the limited liquidity obviously limits the activity of the ZIG, and by and large excessive demand for the foreign currency, which will be chasing the foreign currency from the ZIG. So it's a technical situation where there's limited supply and limited liquidity, and by derivation limited margin or limited bids outside the formal market, which will then create a premium between the official rate and the parallel rate.
Right. Another area where the IMF commended the authorities was the aspect of the inflation, which between February and May, in month-on-month terms, has averaged 0.5%. However, of course, the yearly inflation came in at 92% in the previous month. What's your assessment of the movements in terms of that metric?
I think the month-on-month metric is quite assuring. Inflation is now under the leash; it's under control in relative terms as compared to this time, maybe last year or the previous yesteryears. Then on a year-on-year, it's a technical consideration, considering that there was a devaluation of the ZIG in September 2024. So on a year-on-year, from now until September, there will be a huge margin in terms of difference. But on a month-on-month, there's not been much price differences between the period considering and the commodities under consideration as well.
Right, let's move on to the recommendations at large and why they would be important for Zimbabwe at this very point, starting with the issue of arrears clearance. The IMF did note that there has been some effort to somewhat attend to Zimbabwe's obligations, but IMF is very clear that there should not be a ballooning in terms of the domestic debt. This comes at a time where we've seen the issuance of TBs onto the market. How do you reconcile these two elements?
Well, it's quite a tough time for the government to be having both runaway domestic debt and runaway foreign debt. Domestic debt is inevitable in the sense that there's been an ambitious infrastructure development plan, as well as other demanding and pressing government operations that are largely of legacy in nature, and also so is the international areas. So, look, there's need to ramp up revenue collection for government, but it may not be achievable in the immediate term, given probably the reduced aggregate demand due to limited liquidity in the market and money supply growth. So there's need for an inducement in the economy, which speaks probably why there's been some rumors that the minister is probably looking into a bridge finance. So there's been a bit of an inducement in the economy to boost production, and by derivation increase taxes and capacitate government to be able to perform in its various assets, including arrears clearance, both local and international.
Right, there's also been some allocations to former farm owners, which adds to, of course, Zimbabwe's 21 billion obligation list, I would put it. How important is that, and what signal does that send to the international as well as the local community about government seriousness at meeting its obligations?
I think it speaks to its ability to acknowledge and its ability to probably give the sentiment that whoever is owed will be paid. Maybe not in the immediate term, but in the medium to long term. But over and above that, it speaks to probably confidence index increasing due to acknowledgement of this debt, despite us being under severe debt stress and debt overhang, which is becoming an albatross for medium to long term prospects.
Right, I will ask this. Can Zimbabwe increase revenue without overburdening citizens and formal businesses?
It is possible, but not in the immediate term. There is need for strategic patience for government. We need to cast the net wide. There is a serious economic activity in the informal sector, which government reach at the moment is quite limited due to various aspects such as in compliance by the informal sector. So there's need for government and through the relevant authorities being able to capture economic activity in the informal sector and tax the necessary taxes that are supposed to be collected from there to reduce the burden on the already compliant formal and citizens in the economy.
Right, and of course ordinary citizens, this is where then this comes in. You mentioned the aspect of the informal sector. What other options could government explore given the matrix that we currently have?
Well, there's need for there to be more cohesive approach to ensuring compliance, as well as accommodative and ensuring that there's need for there to be voluntary compliance. There has been some initiatives such as tax holidays and tax breaks and free voluntary compliance without any penalties being levied by ZIMRA, which I think is a step in the right direction. But over and above that, I think it should be a cocktail of aspects beyond tax compliance, such as credit facilities, social safety nets, compliance credits, aspects that are more accommodative and are more accommodating to whoever is informal in the economy.
Well, now time for us to take a breather. When we come back, we continue our conversation on the recommendations of the International Monetary Fund towards Zimbabwe's macroeconomic stability and how that affects you. Beat the market to be right back. Don't go anywhere.
Harare, tune into the beat.
Capitalk 100.4 FM, your source for news, business, sports, fashion, and more.
Experience the pulse of Harare's culture and lifestyle.
Capitalk 100.4 FM, Harare's top radio station.
Join the conversation with Zimbabwe's top personalities.
Subscribe now for fresh and infotainment content daily.
Capital 100.4 FM, Harare's heartbeat.
Captain Wally J's about to take you to boot camp.
It's the riveting science and tech show that keeps you up to date with the hottest gizmos on the block and revealing the illustrious and innovative visionaries in Zimbabwe. So much to see, you'll keep swiping.
This cherry red beauty is the Dairy Auto M7 mini electric car.
They've designed our brute force incubator board.
Look at what we've got here.
Solar powered scarecrow was part of the project that I was supposed to complete.
Catch Swipe every Tuesday at 5:30 p.m. on ZTN Prime, DSTV channel 294. Get the picture?
Didn't graduate? I guess I blew it.
You couldn't advise him anything. He would just look at you and say, so who do you think you are?
We were just like really spoilt.
And then they just give me the receipt and I'd pay.
The guy walks in one day and then he says that he wants to make a movie.
He was blowing the money.
There was just like this habit that he had where as soon as he got money, it was gone.
I just didn't have the skills or the experience.
This money, I could see it disappear so fast.
Welcome back to Beat the Market, the only show in Zimbabwe that deep dives into everything equities, markets and finance. I'm Eben Mapunda and we're coming to you from Zimbabwe's capital, Harare. We are in conversation with economist Malone Gwadu over the recent recommendations that came from the International Monetary Fund, and we pick it up from where we left off before the break. Malone, of course, the IMF there pretty much advocating for a wider adoption of the domestic currency, the ZiG, but of course with guidelines that there should be, at the end of the day, when that transition takes place, the separation between US dollar deposits vis-a-vis ZiG deposits. May you weigh in on that?
Well, generally, I think it's important for any country to have its own currency for its medium to long-term growth prospects. And narrowing it down to where the IMF recommended for there to be separate accounts, to some extent it's already there, where you've got FCA accounts and you've got ZiG accounts. But by and large, I'd submit that there's probably need to be efficiency in terms of how these movements happen between from US dollar to ZiG and from ZiG to US dollar, and more voluntary than surrender in nature. That is the bone of contention between the IMF policy recommendation.
Right. At the same time, the IMF recommends that we do away with the surrender requirements for exporters, which currently sit at 30% of their proceeds, instead advocating for an agency system. What does it boil down to, and why is it important?
Look, from a private sector perspective, it's more than welcome for that to be a recommendation because of the exchange rate value that is being incurred by companies. You'll be aware that majority of companies that are charging exporters benchmark their prices probably in the alternative market and the official market, which is an immediate loss for exporters, and then when they surrender the US dollars. But also from a policy perspective, it's intended to capacitate the ZiG and crank the market for there to be trading of the ZiG. So there's need for a common ground in terms of meeting intended policy framework, as well as private sector buy-in to ensure that the overall ZiG competence is enhanced. The necessity of this is being called upon because of the exchange rate loss that is being incurred between the surrender. Hence the necessity for there to be an agency system where there is voluntary adoption of the ZiG. But with the intended 2030 adoption, it may not necessarily work in their favor. There's need for both a bit of cohesion and a bit of incentive mechanism for there to be trading of the ZiG in the market.
Right. Still on the subject of the currency, IMF recommends that as and when Zimbabwe gets ready to implement the move toward a monocurrency, there needs to be a clear roadmap. And in fact, they are quite clear that the roadmap needs to be ready as soon as possible so that that path becomes clear, and there can also be input of multiple stakeholders at that. How important is that to Zimbabwe's journey? Of course, we do know that the authorities have stated that we're running with, of course, the agenda right up until 2030, where the shift to a monocurrency is concerned.
Well, I think it's necessary for there to be a defined path of how we're going to have a monocurrency. But from the last conversation which we had with the governor, which I think you also a part of, he mentioned that there's need for submission from business of how they want us to proceed in terms of, the monocurrency adoption. So while there's need for there to be a clear roadmap, the buy-in of everyone is also important. So it's a matter of striking a balance between having a roadmap, but ensuring that there's buy-in from CZI, from ZNCC, from Bankers Association, from Chamber of Mines, from every stakeholder in the economy, so that when the roadmap is now being implemented, there's cohesion and adherence to the preset roadmap with the input of every stakeholder in the process.
Zimbabwe's foreign currency reserves are sitting at about 700 million United States dollars. For context, Botswana, that's about 3 billion. South Africa, over 60 billion United States dollars. Why is it important for Zimbabwe to generate its foreign currency reserves, and what's your assessment of the growth that we have seen so far, considering when the currency was launched 14 months back, Zimbabwe was sitting at about 280 to 300 million US dollars worth of foreign currency reserves?
Well, I think it's quite formidable progress. 700 million is not a small amount to be discussing, and given the period that it has happened, and also the policy alignment of this, you'll be aware that government is asked for miners to pay their royalties in kind, which is what is capacitating for the accumulation of the ZIG. So by and large, I would submit that it's a step in the right direction, and there's need to be consistency in terms of ensuring the accumulation and ensuring that the ZIG has its defensive capabilities in the face of volatility, which is where these reserves then come in terms of buying and selling to ensure that the rate, and in case of any volatility, it defends itself in the international fora, with the strategic intent obviously to make it an internationally acceptable currency with the necessary reserves there too.
Right. What reforms are needed to ensure the ZIG operates under a rules-based monetary framework?
Well, gradual refining of the trading system, the currency management framework, in particular the foreign exchange system, in a way that gives it an accurate reflection of how it's priced in the market. But obviously, this is a process. It's not an overnight event, and I believe the will and the intent is there. But over and above that, I would also submit that government needs to play its part in terms of capacitating the ZIG by ensuring and allowing for the ZIG to be tradable and be payable some of the statutory requirements in ZIG, instead of solely accepting US dollars, such as customs duties and excise duties.
Fuel.
Fuel. Well, for fuel, it's a private
passports
sector.
Passports and all of these.
Yeah. It shows and it signals the market that they are really serious for the monocurrency, and they are the first, to adopt the acceptance of the currency in the economy.
Right. How practical is the use of indirect tools like open market operations and interest rate policy at this point?
Well, we are seeing the effectiveness at the moment. As I mentioned earlier, there's serious liquidity crunch in the economy where credit is quite expensive at the rate of 35%, which speaks to the interest rate policy. And by derivation, it has reduced aggregate demand in the economy and also done away with inflation and exchange rate volatility that came about as a result of money supply growth. So it's quite important and it's quite effective. And you also mentioned earlier that open market operations such as treasury bills are also prevalent in the economy, and they're also playing their part in terms of giving an accommodation window for government, as well as money supply arresting tools for the central bank to utilize to ensure that the preset currency management framework is adhered to and there's no threat to it.
Right. I've got to ask this question. Do you think that the RBZ will be ready to limit intervention in the forex market and let the exchange rate really be determined by the forces of supply and demand?
I think the intention is there, but if you look at the three facets of central bank, it's price stability, full employment, and economic growth. So when there's a policy convergence that is inflationary in nature, the Reserve Bank has no option but to come in and defend the market from inflation vulnerabilities. So that is only possible if there are no other threats to its existing objectives in the market.
Right. Let's move on to the fiscal pillar, which is a vital cog to this whole narrative. The subject of cash budgeting against, of course, the backdrop of the preparation of the 2026 national budget. May you weigh in on that?
Look, a cash budget can never be overstated in its necessity. But if you look at the nature of Zimbabwe, where we've got limited lines of credit, we've got competing demands as a country, a cash budget, in my view, in my submission, is an intention, but is a long shot for the government to fully adopt. It can be momentary, but it's not sustainable because, for example, we're under, in debt negotiations where there's need for us to pay some money. We've got an ambitious infrastructure drive, which needs, cash. So there's short-term funding for long-term projects, and you've got limited credit lines for us to utilize to fund these operations. So where does government look? Fiscus. What does this entail? A short position on its cash versus its obligation that it has. So a cash budget, yes, it's a will and intent, but we wait to see the magic, if at all it's possible.
Magic, you are calling it. Because, of course, there's been a clear indication that we could be seeing Trabablers 2, Trabablers 3, and several other projects. We know that there's work under, of course, under the pipeline right in Bulawayo, Victoria Force that's taking place there. Some construction that's still taking place where Mashingo Bait Bridge Highway is concerned. How do we bring a reconciliation to the need to be disciplined vis-a-vis the need to attend to all of those?
In my view, I'd submit that it should not be a cash funded project. There are other models that government can operate.
What are those models?
Build, own, operate, transfer. Build, operate, transfer, or build and own, where we have got a road that is private sector owned for a period of time, then they recoup their investments. Then after a period of time, the government then adopts its value in the project. Because if it is going to be fiscus funded fully, there is an immediate inflationary threat that particular aspect, or there's a threat of there being fiscal risk of there being overfunding in one aspect of government and underfunding in other sectors, such as health, education, social security, and amenities, and all those things. So it's a catch-22 situation.
Right, calls for transparency where the Mutapa is concerned. Why such a call by the IMF?
Well, naturally, transparency speaks to good governance, and it speaks to scrutiny, and it speaks to economic efficiency. So the parastatals under consideration obviously are pivotal to this economy, and there's need for there to be efficiency in these parastatals so that they bring out the intended economic value and the intended strategic economic value that they have for government. So transparency is key for that, and there's need for necessary reforms around governance, around disclosure, around auditing, around reporting, to ensure that in the medium to long term they achieve the intended objectives that are strategic in nature for the economy.
How important is it to receive timely financial statements of the subunits that are under the MTAPA, speaking of Air Zimbabwe, NRZ, and several other institutions that are under this big umbrella?
So you'll be aware that the MTAPA investment is appealing for investments. And obviously any investor also look at the reporting to say what is in this intended entity for my consideration in terms of investments. So reporting is very important for decision making for investors, as well as, look, these are owned by citizens. These are assets owned by citizens. They want to know what is happening in these parastatals. So it's quite important as an assurance mechanism for the general public in terms of what is happening, who it's taking, and how it's going to be done.
Raising a flag on the fact that sometimes you get financial statements in 2025 for the performance of Air Zimbabwe in 2023. How can that be changed and ensure that there is that timeliness where these financial statements are concerned?
Well, I think it then speaks to why it was then necessary to house them under one fund that is more efficient and more private sector owned in a way that and governed in a way that ensures that there's efficiency and there's that push for there to be reporting in time.
Malon Gwadu, thank you for appearing on Beat the Market. Always a pleasure having you in conversation. And of course, that's a wrap on Beat the Market, the only show in Zimbabwe that deep dives into everything equities, markets, and finance. Do follow us on our social media handles at Zim Papers TV Network, as well as at Z10 Prime. Your views and your thoughts are important to us. Remember to catch us every weekday at 2 p.m. Central African Time for the juiciest business stories in Zimbabwe, on the continent, and beyond. I'm Eben Mabunda, the money man. Let them do what they do. When we do what we do, we mean business. Thank you for watching and have a good day.